U.S. nat gas futures fell about 6% to a two-week low on Friday, on forecasts for demand to drop and output to rise as the weather turns warmer than normal in late January and early February. For the week, the front month was down almost 22%, reversing the gains observed in each of the prior 2 weeks. Despite the drop in prices, the flow of gas to U.S. liquefied natural gas export facilities was on the rise after hitting a one-year low during the recent Arctic freeze. This extreme cold spell had led to a record-high daily gas demand and a reduction in output to a one-year low as freezing temperatures impacted well operations. Average gas output in the lower 48 states fell to 102.9 billion cubic feet per day so far in January, down from a monthly record of 108 billion in December. On a daily basis, U.S. gas output was on track to jump 10.3 billion cubic feet per day over the past 3 days to a preliminary 100.8 billion on Friday, after plunging by 17.2 billion cubic feet per day from January 8 to 16 to a 12-month low of 90.5 billion on Tuesday, due primarily to freeze-offs and other cold weather events. Meteorologists projected temperatures in the lower 48 states would switch from colder than normal from January 19 to 21 to mostly warmer than normal from January 22 to February 3. With less cold weather in the outlook, analysts forecast U.S. gas demand in the lower 48, including exports, would drop from 155 billion cubic feet per day this week to 141.5 billion next week and 123.8 billion cubic feet per day in 2 weeks. On a daily basis, total gas demand, including exports, soared to a record 168.4 billion cubic feet per day on January 16. Gas flows to the 7 big U.S. LNG export plants fell to an average of 13.9 billion cubic feet per day so far in January, down from a monthly record of 14.7 billion in December. On a daily basis, LNG Fijas was on track to jump about 4.7 billion cubic feet per day over the last 3 days to a preliminary 14 billion on Friday, after dropping by 5.8 billion cubic feet per day from January 13 to 16 to a one-year low of 9.2 billion on Tuesday, due mostly to reductions at U.S. energy company Cheniere Energy's Sabine Pass in Louisiana and Corpus Christi in Texas, Freeport LNG's plant in Texas and Cameron LNG's plant in Louisiana. The downward momentum suggests a potential continuation of selling pressure next week, particularly as the weather forecast still trending warmer to the first week of February. Of course, a short-term technical recovery is possible due to oversold conditions or if the overnight weather models shift to the colder side on Monday. Additionally, a super bullish storage report is expected next Thursday, which could be utilized by aggressive market speculators to push prices higher in the short term. I anticipate that the $2.40 level will attract significant attention as it represents a zone where we observed strong support in December. In summary, the combination of rising supply, reduced demand due to warmer weather, and the current policy landscape indicates a sustained downward trajectory in natural gas prices for the upcoming week, with the possibility of a short-lived price spike around Thursday. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.